Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. You're listening to episode 352. The title is The Ultimate Podcast on Health Savings Accounts, HSAs. And this is going to be such a good one. I can't wait. This is really going to be a deep dive on this topic. I know you're going to love it. We like to start the morning right two ways. The first one is by renewing our mind. I've got a verse here for us, two verses from 1 Thessalonians 5, verses 14 and 15. And we urge you, brothers and sisters, warn those who are idle and disruptive, encourage the disheartened, help the weak, be patient with everyone. Make sure that nobody pays back wrong for wrong, but always strive to do what is good for each other and for everyone else. Okay, and unfortunately, Amelia is not in the office with me today, so I'm responsible for a joke for you. Why can't two elephants swim at the same time? They only have a pair of trunks. Okay, there you have it. Episode number 352, the ultimate podcast on health savings accounts. Health savings accounts really are the most incredible tool available for retirement savings. Unfortunately, too many people that I meet with are missing out on using health savings accounts as part of their retirement strategy. So I'm going to do a deep dive into this subject, and I really am hopeful that you just get a ton of value out of our time together. But before we do, I was researching and I came across a couple little things. And so I thought we'd do some trivia here to get the show started. I will give you the questions, and then at the end of the show, I'll give you the answers to the trivia questions. What is the largest denomination note currently being issued by the Federal Reserve? Now, when I say note, I mean dollars. What's the largest bill that the Federal Reserve currently issues? That's the first question. The second question is, whose picture has been on the $100 bill since 1914? And then my last trivia question for you is, can you name two people whose picture appeared on the $100 bill before 1914? Okay, so as we dive into this topic of health savings accounts, I want to start out at a high level, and then we're going to get into more of the specifics and some strategies for you to consider regarding health savings accounts. I've compiled a bunch of resources, a lot of links to articles and resources that I know that you're going to find helpful. They're going to all be available to you in the show notes. Just visit episode 352 at soundretirementplanning.com and click on episode 352 to have access to all of the show notes. Health savings accounts have only been around since 2003. And I found a report by the CDC from 2018 that said among adults between ages 18 to 64 with employment-based coverage, the percentage enrolled in high-deductible health plans with an HSA increased from 4.2% in 2007 to 18.9% in 2017. So the good news is more people are learning about these accounts and more people are utilizing them, but still only 18.9% of people are using the high-deductible health plan in conjunction with a health savings account. How do you qualify for a health savings account? There's a couple of things here. So number one, you are covered under a high deductible health plan. You have no other health coverage. Now, there are some nuances here that are pretty random, and I'll refer you to IRS publication 969 if you have questions, but you can't generally have any other health coverage. You are not enrolled in Medicare, and you can't be claimed as a dependent on someone else's tax return. What are the benefits of an HSA? You can claim a tax deduction for contributions you or someone other than your employer make to your HSA, even if you don't itemize your deductions on Schedule A. Contributions to your HSA made by your employer, including contributions made through a cafeteria plan, may be excluded from your gross income. The contributions remain in your account until you use them. The interest or other earnings on the assets in the account are tax deferred, And distributions may be tax-free if you pay qualified medical expenses. An HSA is portable. It stays with you if you change employers or leave the workforce. If used for qualified medical expenses, the money comes out tax-free. And unlike an IRA, you don't have to wait until age 59 and a half to start using the money penalty-free. As long as the money is used for qualified medical expenses, you can access the account with no penalties or taxes. So in essence, you get the benefits of the tax deduction like you would from an IRA and tax-free income like you would from a Roth IRA. It combines the best of both worlds, tax deductions and tax-free income when taking the money out for qualified medical expenses. It's more liquid than an IRA because you don't have to wait till age 59 and a half to access the money without a penalty. Unlike an IRA, there's no required minimum distribution, so you will not be forced to take withdrawals at age 72. Money in an HSA is carried over to future years. And if the HSA is being offered through your employer, it's a portable benefit, meaning that you can take the HSA with you if you leave your job. So this makes the HSA unique compared to some of these other health savings accounts that are available, such as a FSA or an HRA. Please note that the HSA is different and, in my opinion, better than the FSA or HRA. FSA stands for Flexible Spending Account. HRA stands for Health Reimbursement Arrangement. HSA stands for Health Savings Account. Because there are so many different types of these accounts, it can be confusing. Today, we are talking about HSA, Health Savings Account. So why would you want an HSA? And there are several reasons, but I'll give you a couple. Number one, Fidelity's recent study states that on average, a 65-year-old couple will spend about $300,000 on healthcare costs in retirement, not including the cost for long-term care. So we need to plan on how to pay for healthcare in retirement. If we only have money saved in IRA and 401k accounts, and then we have a medical expense, we'll have to pay taxes on every dollar when we pull out of those accounts, even if those dollars are used for health-related expenses. Whereas if you have an HSA, you can access that money tax-free. That's incredibly valuable. Number two, health insurance is expensive. I don't know about you, but I get zero joy from spending money on health insurance. But it does provide me some peace of mind. If you're healthy and don't spend a lot on health care and medical costs every year, a high deductible health plan helps you keep your insurance expenses low. With insurance, for me personally, I want as much as I need, but not a penny more. Number three, the HSA is an account that can be invested for long-term growth, but not all HSA providers have investment options. Number four, because dollars contributed to an HSA offer a tax deduction, it helps you pay less money in taxes every year. So a question would be, if these HSA accounts are so good, why are only 18% of Americans using them through their employer? Well, with this podcast, I hope to change that. I hope the high deductible health plan and HSA health savings account become one of the most utilized retirement accounts. So please be sure to share this episode with people you care about. Now, choosing health insurance. There's a lot that needs to be considered with which health insurance plan you will choose. If you know that you're going into a season of life where you're planning on higher medical expenses, such as maybe you're planning to start a family. Sometimes those babies coming into the world can be really expensive. Or maybe you're planning for some type of surgery, maybe a knee replacement surgery or hip replacement surgery, or you're going to have a back surgery. Then it probably makes more sense in those instances to choose a low deductible health insurance plan if you know that you're going into a season with a lot of medical expenses. What are the requirements for the high deductible health plan to qualify as HSA eligible? It's possible to have a high deductible health plan that is not HSA eligible. So a high deductible health plan that's HSA eligible in 2021 means that if it's a self-only plan, it needs to have a minimum deductible of $1,400 for the year and a maximum out-of-pocket of $6,900 for the year. If it's family coverage in 2021, it needs to have a minimum annual deductible of $2,800 with a maximum out-of-pocket for the year of $13,800. Even when I see people that have lower deductibles that have healthy families, let's say they have a lower deductible of $500 per year, I see a lot of families who are not even meeting their annual insurance deductible every year. And so this is where the high deductible health plan can really make a lot of sense. Comparing plans. I recently visited the Washington State Health Plan Finder website to compare plans. I looked at a few offerings in my state and in my county. And this is just a hypothetical make-believe couple, but I assumed that there was a married couple, they're both age 40. And I looked at a low deductible plan versus a high deductible health plan that was HSA qualified. And then I also looked at a high deductible health plan that was not HSA qualified. When comparing the low deductible plan to the high deductible health plan that's HSA qualified, the monthly cost savings was anywhere from $200 to $300 per month for the high deductible health plan compared to the low deductible plan. So if you opted for the high deductible health plan and you don't have a lot of medical expenses, you could be saving $2,000 to $3,000 per year in insurance premium expenses. Now, when comparing the high deductible health plan that was HSA qualified versus just a regular high deductible health plan with no HSA qualification, so in other words, you can get some insurance with the highest possible deductible, the highest out-of-pocket annual limits, but then you cannot contribute to the HSA. Those plans could save you an additional $150 of insurance premium, but if you choose one of those plans that are not HSA qualified, you would forfeit your ability to make contributions to an HSA. I think of the high deductible health plan as more catastrophic coverage. You want to have some insurance in place if something really bad happens, but if you're willing to cover the deductibles and the maximum out-of-pocket costs for a year out of your savings, then these could be good plans for you. If you choose the high deductible health plan with an HSA in this scenario, you've now saved over $2,000 per year that you would have otherwise been spending on the insurance company every year if you had selected the lower deductible plan. Because you have a high deductible health plan that's HSA friendly, you are now eligible to contribute to an HSA. In the year 2021, the HSA says you can contribute up to $3,600 for an individual or $7,200 per year for a family. If you're over the age of 55, there is a $1,000 catch-up contribution. So now that we can see that we can save money on health insurance costs, let's consider the tax benefits of signing up for an HSA. Our national debt is currently over $28 trillion. We're creating and spending money like there is no tomorrow. We have all-time low tax rates in our country right now. The question that we need to be asking is, will they be going lower? Or is it possible that taxes will increase in the future? We know that right now, if nothing changes, taxes are set to increase, and the current low tax environment is going to expire in 2025. So we're going to look at how a contribution to an HSA would work today if you set up an HSA and a high deductible health plan with an HSA. And if you believe taxes could be going higher in the future, it could make the tax deferred growth and the tax-free benefits of the HSA that much more valuable in a future where taxes could be higher. I like the idea of maxing out the HSA and, if possible, not spending the HSA as you go. Rather, create a big bucket of tax-free money for future healthcare costs. As we dive into taxes, remember, taxes are like fingerprints. Each person's situation is very unique and very specific to you. Please understand that this is a hypothetical situation, and hypothetical means it's make-believe. You're going to want to check with your financial advisor or your CPA for the specifics on how taxes will affect your situation as it relates to your contributions to an HSA. This is hypothetical and taxes are complicated, so please don't assume that this is how it works for you. But in this make-believe scenario, I created two very simple tax returns. So let's say we have our hypothetical couple that's 40 years old, and between the two of them, they're making $150,000 per year in wages. We will assume that they take the standard deduction. Their total federal tax, assuming that they do not have an HSA, would be $18,975. This puts them in the 22% marginal bracket with an effective tax rate of 12.7%. If we kept everything the same, but we added the maximum HSA contribution of $7,200 in 2021, total federal taxes would be $17,391, which is a tax savings of $1,584. So in this hypothetical example, not only did this couple pay $2,000 less in insurance premiums as a result of having the high deductible health plan, but they also paid $1,584 less in taxes, assuming they made the full $7,200 contribution to an HSA. So the annual cost savings between insurance and taxes is $3,584 per year. Now, let's look at how much money they could have in the future. So again, taking our 40-year-old couple, let's say they plan to retire at age 62. If we assume that they save $7,200 per year for the next 22 years, that they never increase the savings with inflation adjustments or catch-up contributions, and let's say they invest $7,200 from age 40 to 62 and their investment account grows at 5% per year. In 22 years, they would have nearly $300,000 available in their HSA that can be used tax-free to help pay for future medical costs. If their HSA grows at 7% per year, they would have approximately $384,000. If the cost of medical care today for a retired couple is $300,000 over a couple's retirement, you figure in 20 years, that will likely double to probably about $600,000. And if you had made the $7,200 contribution every year for the next 22 years and you earn that 5% investment return, you'll have $300,000 available to cover expenses. And hopefully, not all of the medical expenses are going to occur that first year of retirement. You now have a $300,000 account that will continue to work and grow and be there for you to cover most of your medical expenses in retirement. The key is you've got to get started. Catch-up contributions. Most people know that starting at age 50, you can do catch-up contributions to your 401k and IRA. Well, our lawmakers like to keep us on our toes, and they decided to make catch-up contributions for the HSA start at age 55 rather than age 50. If you and your spouse are age 55 and both have qualified high-deductible health plan coverage in 2021, you can contribute $7,200 to an HSA plus an additional $1,000 per person. Now, a lot of people miss the extra catch-up contribution. I see a lot of tax returns of people aged 55 plus who both are covered under qualified high deductible health plan and they have an HSA account, and they think they're making the maximum contribution because they do the $7,200 plus an extra $1,000 for a total of $8,200. I can see this because it's reported on their tax return. The couple can actually make a total contribution of $9,200 because they get the $1,000 per person of catch-up contributions. It's per person. But for this to work, the spouse needs to have their own HSA account to make up the catch-up contribution. There is no such thing as a joint HSA. If you only have one HSA, then it would be $7,200 as the family max plus the $1,000 for the person who owns the HSA. But if your spouse has their own HSA account, you can contribute an extra $1,000, making the total contribution for those over age 55 $9,200 per year. There are several other nuances that you need to be aware of. If your employer contributes to your account, it reduces the amount of the contribution you can make. So again, if you're 40 years old, the maximum contribution is $7,200 in 2021. But if your employer contributes $1,000 on your behalf, then the most you could contribute would be $6,200. You can have more than one HSA account, but the maximum contribution is limited to the annual max. Coordinating HSAs among couples. So first, let's look at if both couples have self-only high deductible health plans and they each have individual HSAs. If a husband and wife each have a self-only high deductible health plan, and HSA account, they are limited to the annual max of $3,600 per person. So if the wife maxes out her HSA for, say, $3,600 for the year, but her husband would need to max out his HSA for $3,600 also. But let's say the husband decides he's going to buy a boat and he doesn't want to max out his HSA. Instead, he contributes $0. Unfortunately, $3,600 is the most that can be contributed by the wife. She cannot make up the extra contribution for her husband in this situation because they each have self-only HSA plans. Now let's look at a very similar situation. In this case, we'll say that couple has kids. So we'll say one person has a family high deductible health plan and the other has a self-only high deductible health plan, and they both have an HSA. In a scenario where the wife is covered under the family plan and she has the kids covered under her plan, and the husband is covered under the self-only plan, if the family max is $7,200, they could each contribute $3,600, just like in the last scenario. But just like before, let's say the husband buys the boat and contributes nothing to his HSA. Well, because the wife has a family plan, she is not limited to only contributing the $3,600. She can actually make up for the lack of contributions her husband did not make, and she can contribute the full $7,200 because she has a family plan. Or they could mix and match. Let's say the husband contributes $1,000 to his HSA, and then the wife could contribute an additional $6,200 to the family plan to get them up to the max of $7,200. If this all seems confusing, be sure to visit episode 352, and I will have links to articles for your additional reading pleasure. Investment growth. There's no guarantee that your money's going to grow inside of an HSA. Some HSA accounts work like traditional savings accounts at a bank, and they pay very little interest in today's interest rate environment. I was at the bank the other day, and they had a sign in the lobby saying to ask about their special CD rates. And I asked the teller, "What does CD stand for?" She said, "Certificate of Disappointment." Just kidding. Many HSA accounts offer investments where you can buy stocks, bonds, mutual funds, and ETFs. Now, let me just say, when I first signed up for an HSA years ago, I thought I was going with a really good provider. Initially, there were no investment options available within the account. Eventually, they added investment options, but it was really clunky to find your way around. And so it was so frustrating that I oftentimes did not invest because it was just really complicated to use the platform. I'm so glad to report in recent years, these platforms have gotten so much better. These custodians have gotten so much better for managing HSAs. So if you're dissatisfied with the way your HSA works, or if they don't have investment options, if they only have cash options like a savings account, you can transfer that money to a new HSA, accessing the money in the HSA for non-medical purposes. If you access your HSA and use the money for non-qualified, non-medical distributions, then you get hit with a 20% penalty if it's before age 65, and the distribution counts as ordinary income. If you become disabled or you're age 65, you can access your HSA without the 20% penalty, but it still gets taxed as ordinary income. So it's just like if you're taking money out of a traditional IRA. You lose the tax-free benefit if it's not used for medical expenses, but you can still access the funds for non-medical reasons. It's like a traditional IRA where you never have to take a required minimum distribution. What can you spend your HSA account on that's tax-free? Qualified medical expenses are those expenses that would generally qualify for the medical and dental expense deduction, and you can find more details on this via IRS publication 502. After 2019, over-the-counter medication, prescribed or not, is considered a covered expense. Medical expenses incurred before you establish your HSA aren't qualified medical expenses. This is an important reason to get your HSA established as soon as possible. I'm going to share this with you again. Medical expenses incurred before you establish your HSA are not qualified medical expenses. You got to get this thing started now. You might be surprised by what qualified for medical expenses means. So here's from publication 502. Certain improvements made to accommodate a home to your disabled condition or that of your spouse or your dependents who live with you don't usually increase the value of the home, and the costs can be included in full as medical expenses. These improvements include, but aren't limited to, the following items: constructing entrance or exit ramps to your home, widening doorways at entrances or exits to your home, widening or otherwise modifying hallways and interior doorways, installing railings, lowering or modifying kitchen cabinets, moving or modifying electrical outlets, modifying fire alarms, modifying stairways, adding handrails, modifying hardware on doors, modifying areas of the front of an entrance and exit doorways, grading the ground to provide access to the residence. You're going to want to be careful about coordinating your tax return and your HSA spending. You cannot deduct qualified medical expenses as an itemized deduction on Schedule A that are equal to the tax-free distributions from your HSA, so no double dipping. You cannot treat insurance premiums as qualified medical expenses unless the premiums are for any of the following. These are the areas you can use HSA accounts for insurance premiums. Number 1, long-term care insurance, subject to limits that are based on your age. Number 2, healthcare continuation coverage such as COBRA. Number 3, healthcare coverage while receiving unemployment benefits. Number 4, Medicare Part A, B, and D premiums or Medicare Advantage plans, but not Medicare supplemental plans, which are commonly known as Medigap coverage. There are no income limitations on who can set these things up. One of the nice things about the HSA is that there are no income limitations on who can have access to these accounts. If you're considered to have high income, you get phased out of a lot of tax deductions, and you can no longer make Roth IRA contributions, unless, of course, you're doing something like the backdoor Roth IRA. But that's not the case with HSAs. Some people say that this is a special tax deduction that you don't lose due to having high income. Very, very valuable for those of you that are high income earners. Who is the best HSA provider? Morningstar did an analysis of HSA providers, and I'll include a link to the article in the show notes, but here's a quick summary of their findings. The top 3 HSAs as spending accounts were Fidelity, Lively, and Health Equity. The top 3 HSA providers as investment accounts were Fidelity, the HSA Authority, and Health Equity. I'll include a link in the show notes if you want to look at the pros and cons of the various HSA providers, but I have to tell you, my personal favorite is Fidelity. What happens to my HSA when I die? HSAs, while incredible while you're alive, are not very tax-friendly upon death. So this is an account that you're going to want to spend. Oftentimes, people can rack up a lot of medical expenses their last year of life. One of the great things about the HSA is that the proceeds can be used to pay these medical expenses for up to 12 months after the HSA owner's death. So you're going to want to make sure that you're talking to your family and that they understand how the HSA accounts can be used. If your spouse is named as beneficiary of the HSA, they can continue the account as if nothing really changed. If you name your kids as beneficiary or any other non-spouse beneficiary, this triggers a tax hit. All of the HSA becomes taxable in the year of death on the kid's tax return based on the kid's tax situation or whoever the beneficiary is. You can name your estate as beneficiary, in which case there's a special rule that says the HSA is included in the HSA owner's final tax return. This might be the better strategy if your estate is in a lower tax bracket than your kids or other beneficiaries would otherwise be. If you name a charity as the beneficiary of your HSA, then the tax issues go away. So next I want to share with you some strategies. For those of you, those 18% of you that have the HSA, let's talk about some strategies using the HSA. First of all, accumulated health expenses. Once you get your HSA established, keep all receipts and try not to spend your HSA account. Keep receipts for all your healthcare expenses using a tool like Evernote or Google Drive, and then create a table or a spreadsheet to track those expenses. Take pictures of the receipts to include with the spreadsheet. Let's say you do this from age 40 to 62 and you have an HSA the entire time. You're tracking your healthcare expenses, but not using the HSA as you go. And then you retire at age 62. And then let's assume over that 22 years that you had the HSA, that there were $66,000 of healthcare costs. You never itemized those costs on your tax return, and you never used the HSA to pay for any of those expenses. These are just your accumulated costs over the years. During that time, because you did not spend from your HSA, so those costs have never been reimbursed. You decide to retire at age 62, and let's say that your budget that first year of retirement requires $66,000, just for simplicity. The year of retirement, you could reimburse yourself for all 22 years of medical expenses incurred and have $66,000 of tax-free income. Because all of this income is tax-free, it would open the door for you to consider doing a Roth conversion. Or maybe, instead of taking all of the tax-free reimbursement income in 1 year, you spread the $66,000 over 5 years to help keep your income low, to allow for either Roth conversions or to help keep your income low so that you qualify for the Affordable Care Act tax credits to help cover health insurance costs until you turn age 65 and Medicare starts. It's very important to have impeccable record keeping for this strategy to survive an audit. Let's say you plan to retire at 63 and a half and you're going to be eligible for COBRA for 18 months. Remember, HSAs generally cannot be used to pay for private insurance once you retire, but the funds could be used to pay for your COBRA for those 18 months leading up to age 65 when Medicare starts. Remember, once you're on Medicare, you can use your HSA to reimburse Medicare Part B and Medicare Part D premiums. So even though your Medicare Part B premium will likely automatically be deducted from your Social Security every month, you can reimburse yourself tax-free for the costs of Medicare Part B and D. Review your beneficiaries and consider naming your spouse as the primary beneficiary so that they can continue to enjoy the HSA for tax-free health care expenses after you pass away. Consider naming your favorite charity as a contingent beneficiary to help reduce taxes once you have both died. The HSA says that once you reach age 65, you can take money out of the account without the 20% penalty. So one strategy would be to prioritize HSA contributions to the older spouse so that funds become available without a penalty at age 65 if needed. Consider a qualified HSA funding distribution. The IRS gives you a one-time opportunity to transfer money from your IRA to your HSA without any tax. This is almost like doing an IRA to Roth conversion, except it's tax-free. You are getting money out of your tax-hostile IRA and into an HSA account where the money can come out tax-free. The two best times to consider a qualified HSA funding distribution would be when you are young and you're getting started and you don't have the extra money to make a contribution to an HSA, but you have the money in your traditional IRA. This gives you a longer time period for that money to grow and compound tax deferred and to be used tax-free. The second time to consider doing a one-time transfer would be after you and your spouse are both age 55 or older. This way you could transfer the family maximum plus the extra $1,000 per person in catch-up contributions. The distribution from your IRA is not included in your income, but it's also not deductible and reduces the amount that can be contributed to your HSA. It's important to understand that a qualified HSA funding distribution needs to be done via direct transfer from custodian to custodian, and there is a testing period, which means if you don't follow the rules, there are consequences and penalties. Here's how the testing period works. For a qualified HSA funding distribution, the testing period begins with the month in which the qualified HSA funding distribution is contributed and ends on the last day of the 12th month following that month. For example, if a qualified HSA funding distribution is contributed to your HSA on August 10th, 2021, your testing period begins in August 2021 and ends on August 31st of 2022. In summary, an HSA is one of the best but most overlooked retirement plans available. They are best for people who do not have a lot of healthcare costs every year and have the money to make the maximum contribution to an HSA. You enjoy lower health insurance expenses compared to a low deductible plan. You get tax deductions for contributions, tax-free growth, easy access to the money, investment opportunities for long-term growth, and a plan to cover health-related expenses in retirement. There are no required minimum distributions, and after age 65, you can access the money for non-medical expenses without the 20% penalty. If you do not currently have an HSA, I highly recommend you visit episode number 352 and start reviewing all of the resources and the links that I've made available for your review. So here are the answers to the trivia questions. The largest note currently being issued is the $100 bill. The largest note ever issued was $10,000, but those were last printed in 1945 and last issued in 1969. Whose picture is on the $100 bill and has been since 1914? Benjamin Franklin. Name at least two people who have appeared on the $100 bill before 1914. Here's the list. The question is, can you get two of them? General Winfield Scott, George Washington, Abraham Lincoln, Thomas Hart Benton, James Monroe, David Farragut, John J. Knox, and the image of a bald eagle. Since we're talking about good old Benjamin Franklin, here are a few quotes from his timeless book called The Way to Wealth. An ounce of prevention is worth a pound of cure. A penny saved is a penny earned. An investment in knowledge pays the best interest. I hope you found this podcast episode to be an investment in knowledge. Thanks so much.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.